Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.
And there we go. We've got some sound back. For those of you who are watching on the live stream, thank you for being patient with me. We've got the sound back now. So I battled. I don't know why it wasn't picking up the audio. We're doing a little bit of a music break on Berg Studio. And for those of you who are joining me on the live stream, it is good to have all of you on board. And yeah, we've got LinkedIn on board at this morning, as well as some community forums. So yeah, looking forward to sharing some insights with you. And what we're going to talk about today is some consumer questions that people ask. So I'm going to have a chat and discuss some of those questions. So in the meantime, let's quickly have a small video play for the next minute or so about how an RA works. So let's look at retirement annuities first. Now, if I still remember my dates correctly, the first retirement annuity was only launched in South Africa in 1957. I could be wrong. It could be 51. It could be 56. But if I remember correctly, it's 1957. I tried this morning to go and find the exact date, but I couldn't find the exact date. But it was in the 1950s. So we tend to think that these kind of savings vehicles and the way we prepare for retirement has been around for generations. And actually it hasn't. Actually, these retirement annuities, these products have only been around for about one generation. So if you are told that this is the solution for retirement, it's not because people have proven it over and over and over again. In actual fact, if you look at the proof, most of these products don't really solve the retirement crisis, or the retirement problem. But it was launched in 1957. The first company who launched a retirement annuity in South Africa was Liberty Life, and they then, all the other companies came on board, legislation was passed, etc., etc. So what a retirement annuity actually is, it's like a personal pension fund. So it works similar to a pension fund you would have at work. It's just you contribute towards it personally, and initially it was created and developed to add to pension funds that people have. Over time, group schemes, pension funds have become less predominant. In the past, most companies, especially big corporations, had their pension funds. Now more and more companies, especially small medium enterprises, don't give group schemes, which means the role of the retirement annuity has become more and more important in people's retirement planning in their lives. So what are the benefits of a retirement annuity? The first thing that everybody tells us about is that you get tax benefits from your retirement annuity. You can claim back your premiums that you pay from tax. But what does that actually mean? So the first thing you need to understand is that there's a limit to how much you can claim back from tax for your contributions towards your retirement annuity, and for that matter on all your retirement savings. So that includes your pension fund at work as well as your retirement annuity. So in total, you cannot claim back more than 27.5% of your total gross taxable income. So taxable income. So your gross taxable income, 27.5% of that you can claim back from tax for retirement contributions. But that includes all retirement contributions. It includes your pension fund, and it also includes your retirement annuities. But there's also a maximum limit of 350,000 Rand per year. So if 27.5% of your taxable income is more than 350,000 Rand per year, then you can't claim more than 350,000 Rand per year. Now, let's quickly talk about how you actually claim it back, because people think that if I put 1,000 Rand a month into my retirement annuity, that's 12,000 Rand per year, I'm going to get 12,000 Rand back at the end of the year from tax. That is not how it works. You don't claim your premiums back. What happens is any contribution you make towards your retirement annuity reduces your taxable income, and you will get the benefit of a lower tax that was necessary for you to pay. So I'm going to explain it and try and do it in simple terms, or as simple terms as possible. So let's say, for example, you earn 100,000 Rand and your tax on that 100,000 Rand is 20%. So 100,000 Rand for the year, 20%, that is 20,000 Rand tax for the year that you have to pay. But you go and you contribute 20,000 Rand for the year towards your retirement annuity. So that means your taxable income has now dropped from 100,000 Rand to 80,000 Rand. 20% of that 80,000 Rand is 16,000 Rand, which means you've paid 20,000, you only had to pay 16 because of the credit from your retirement annuity, which means you will get a refund of 4,000 Rand on your tax. Okay, so if you want to calculate, the easiest way is to take your contributions, calculate your average tax rate, and that's something we might want to discuss in a different topic. Exactly how much tax do you pay? Because people tend to think their tax is a much higher percentage than it actually is. But take your average tax rate and multiply your contributions by your average tax rate. So if you're contributing 20,000 Rand a year, your average tax rate is 20%, you will get back approximately 4,000 Rand from the 20,000 that you've contributed towards your retirement annuity. So you're not getting all the premiums back, you're getting a percentage back from your retirement annuity contributions. Now, what we always say is that what I suggest is that you take that amount that you get as a tax credit and you put it back into your retirement annuity. Because that money you're getting back as a tax credit is actually free money. And the moment you put it back into a retirement annuity again, you're getting a tax credit on that tax credit again. So if you take that 4,000 Rand, you put it into your retirement annuity, you're getting 20% on that 4,000 again, which is another 800 Rand. If you put that back into your retirement annuity, you're getting another 20% on that 800, which is another 160 Rand, and so on and so forth. So you can continually put that money back into your retirement annuity so that you're getting free money going into your retirement annuity over time. Now, the reason you can do that is because on a retirement annuity, you can contribute towards it on a monthly basis, which most often is the case. People take out a retirement annuity for 1,000 Rand a month, 2,000 Rand a month, and every single month the money comes off your account. Or you can do it as ad hoc contributions as well. So you can say, listen, I want to add 10,000 Rand or 20,000 Rand or 50,000 Rand as a once-off contribution towards my retirement. And welcome back, everyone. Welcome to the people on our social media, LinkedIn, Facebook, YouTube, and then some of the community forums in our area. I'm happy to be with you. I apologize for the gremlins we had this morning. Had a bit of an issue with our audio, had an issue with our streaming. It's been a very interesting morning, especially me being on my own in studio this morning. So what are we going to talk about today? Before the break, I told the people on our social media the topic, but for those of you who are listening on Berg Stereo, let's quickly talk about the topic. And we're going to talk about a few consumer questions that people ask often. It's an article that I got on the internet, and it's 3 questions that people asked, and then I'm going to go through the answers that the financial advisors gave, and I'm going to share my opinion on if I do agree with the financial advisors, and some extra information about that as well. In the meantime, in the breaks, as you all know, the guys on social media can't listen to our music, so we have to do like a breakaway video for you guys while we're playing music on Berg Studio. So you guys will have a video on how a retirement annuity works, which you've seen a part of. I'm going to finish that video, and then also we're going to talk a little bit about a will and why it's important, and why you need a will. And then the last topic is what affects your life cover premium. So if you want to know why somebody pays a little bit more on their life cover than somebody else, you are welcome to listen to that one. So let's get started and run through our Okay, I think there I'm back. Had my sound issue. So let's quickly go through some of the questions that people ask, and run through the first one with you, and then I will share my thoughts on it. So it was placed in the personal finance of iol.co.za, and the question asked is, the client asks, I've bought the property that I currently live in, and I've decided to rather pay my usual monthly retirement annuity, RA premium, into the bond instead, with the aim of lowering the bond as soon as possible. Is this the right thing to do, or is it better to be paying towards an RA as well as trying to pay off the bond? Paying both just seems very inaccessible to me at the moment. Okay, so what was the answer from the financial advisor? So let's quickly run through that answer. The simple answer is generally that one should first pay off debt before investing. Yeah, he says it's the simple answer, but that is the typical rule of thumb. And we also advocate that people get rid of their debt, but we focus purely on unsecured debt or bad debt. That is the consumer debt. It is the debt on your credit card, your personal loans. Not necessarily paying off your bond first and your car before you start investing. And I will give you my opinion and tell you why I say that as we go through. So he continues saying, paying off your bond generally gives you access to capital, and hopefully you only use this for acquiring assets and not for consumption expenditure. It also makes most people feel free of the debt burden. All of these are important financial goals. Paying into an RA is also a good investment option, but with an entirely different investment horizon, as you can generally only access these funds after age 55. Assuming a growth rate of 10% and a tax rate of 25%, you can see that there are great advantages to investing effectively 25% more into an RA than any after-tax alternative. So, he talks about the tax benefit in a very roundabout way. The fact that you can claim back some of your contributions to your retirement annuity. But he simplifies the fact that it is better in an RA than any other after-tax alternative. So yes, there are tax benefits, and I always advocate those tax benefits. But it's not as simple as that, because remember, any tax benefit you get up front, you are going to pay tax on the proceeds at the end. Where if you don't get a tax benefit up front, you get the proceeds tax free. So it's not as clear cut as, well, you get a 25% tax refund, therefore you're already 25% better off than putting money in an after-tax alternative like an endowment. He says, if you are paying 5,000 Rand per month into your bond with after-tax money, you would effectively have been able to pay 5,000 times 75 times 100, that's 6,667 Rand per month into an RA. So what he's explaining there is, he's saying that if you take 5,000 Rand and put it into your bond, you could have put 6,600 Rand into an RA, get the tax benefit, and get back to the 5,000 Rand. There's also an amount of 500,000 Rand available at retirement, which is taxed at 0%, provided the aggregation of retirement benefits is not applicable. So if you look at that 500,000, that is for all your tax benefit, all your tax payouts, your retirement payouts. So if you've already taken money from your retirement annuity and they've already allocated towards that 500,000, you won't have the whole 500,000 at zero tax. As you cannot afford both the bond and RA, I would support your decision to pay off your bond first. The results above are dependent on your actual tax rate and return assumptions, and I would advise you to approach a professionally qualified advisor to give you a more comprehensive answer than that set out above. So what are my thoughts on that? So I think the only good advice that came out of that is the fact that you need to speak to a professionally qualified advisor to look at your whole situation before you just make this decision. I do not agree with the person saying, as you cannot afford both the bond and the RA, I would support your decision to pay off your bond first. If you do the calculations in theory, if you sit down, you look at the extra amount, you then pay off your bond first, let's say that takes you 10 years, and then after the 10 years, you take all the money you are now saving on a monthly basis and putting that into an RA or an investment, theoretically, you will be better off at the end when you do retire. The problem is, it is theoretical. In practice, this is not how life works. So although in a strict theoretical sense of the word, the advice that he gives is correct, in practice, it is not correct, because this is what happens. You buy your first house and you say, listen, I'm going to first pay off my house, then I'm going to start investing for my retirement or start putting things away for my retirement. Then you get married, you put all your money into your bond, And when you get to your 30s, your a wife gets pregnant, you're now starting a family, suddenly the house is not big enough anymore and you have to upgrade. So what do? You go and buy a bigger house. Now suddenly the bond starts all over again. You've got another 20-year bond, and you do that again and again. So although in theory, if you could go and first pay off your bond, stay in the same house for the rest of your life, and then start investing, in practice this almost never happens. So to bank all your retirement security on the fact that you're going to do it that way is for me a high risk. I do not like the whole either or scenario. I'm not saying don't pay off your bond faster. At iRetire, we teach people 4 strategies to pay off their bond in half the time. Without you having to give up on your retirement planning, you can have 4 other strategies that will help you pay off your bond in half the time. So as a student in our coaching program, you will be taught these systems. So while you are building your financial security, while you are building your wealth and planning for your retirement, you can still pay off your bond in half the time in any case. So it's not, for me, supposed to be an either or scenario. You want to find a way to do both. It also starts, I look at what the client says that he cannot afford to do both, but that's why you have to go back first and look at your budgeting, look at your cash flow management, do what we call your strategic expense planning, and make sure that you optimize how much positive cash flow you have. I promise you, if this person was earning 30 or 40,000 Rand a month, if he sits with a coach and he does his strategic expense planning, he will probably get another 4,000 to 5,000 Rand extra over and above what he's already paying into his bond or into his retirement annuity. So it's all about managing your finances. It shouldn't be an either or. You should have a strategy that does both of those. Like I said, in theory, you could potentially pay off your bond and then only start investing. But in practice, it is not going to work. In my 23 years in the industry, I can count on my one hand where a person has done that successfully. It is very, very, very seldom that happens. Okay, so let's take another music break. Our band for today is AC/DC, and we're going to listen to You Shook Me All Night Long. And then those of you who are watching on our social media, let's continue with our video on how an RA works. Retirement annuity. So when you get these tax credits or this tax refund, you can immediately take that tax refund and just contribute it towards your retirement annuity again, and it will count towards your tax benefits for the next tax year or the next financial year. Just a quick shout out, Frikkie and the new interns at our office. All say hello. Hi Frikkie, hi new interns. Great for you guys to listen to us. Welcome. For those of you who don't know, we run internship programs at iRetire and Retire Rich and Happy to teach some of the young people some experience in our industry, in running a business, in the different areas, so that they can get practically prepared for the future. So welcome, and we hope you are enjoying your time with us. Okay, so that's the tax benefits. Now, another tax benefit that people don't often explain with retirement annuities is that your retirement annuity is taxed at a lower rate internally than another type of investment. So for example, another investment is something like an endowment. So if you take 500 Rand a month and you put it into an endowment product, it's a savings plan, and you put 500 Rand into a retirement annuity, and both of these investments invest in exactly the same fund. So you don't have different funds. You invested in the same fund. The retirement annuity will give you a higher return over time than the endowment, because inside of these products, tax are being calculated and paid over, and your retirement annuity is taxed at a much lower rate than your endowment. Your retirement annuity is also exempt from capital gains tax, where your endowment capital gains tax is paid inside the product every time trades happen in your underlying investment funds. So your retirement annuity will have a lower tax rate, which means it will have a higher return over time. Another benefit from your retirement annuity is that it is protected from creditors. So this is a big one. The money that you have invested in your retirement annuity as well as your pension fund at work, though that money is protected from creditors. So if worst case scenario happens and you have to be sequestrated, they can come and attach any of your assets in your personal name, but they cannot attach your retirement annuity and they cannot attach your pension fund money. So you can sit with 10 million rand in a retirement annuity and nobody can touch it, not even you for that matter. You can also not put a retirement annuity on as security for a loan because it cannot be attached by creditors. So it is a protection. It's a worst case scenario protection for your retirement. So if everything else fails, you still have the money left in your retirement annuity. And that for me is a very big benefit, especially for people like self-employed individuals, because a lot of people that have their own businesses feel that, but why should I put money into a retirement annuity? I would rather invest it in other things. Well, there's still that benefit, because in business things can go wrong. And if something Welcome back, everyone. For those of you on Berg Studio, you listened to some AC/DC. That's our band for the day. And those of you on our social media, we spoke a little bit about how an RA works, a retirement annuity. So how can you get in contact with me? If you want to ask some questions, you are welcome to send me a message on YouTube, on LinkedIn or Facebook. And then also you can WhatsApp me directly at 082-801-6693. I'm going to repeat that, 082-801-6693. You can WhatsApp me there. And then also, if you are listening on Berg Studio, you can just press the shout out button at the top of the page, and you can give me a question, and I'll be happy to answer your questions online, so or on air. So let's continue with our second question. This is a short question, but it's quite a long answer. So let's run through that. It says, in the case of my will and testament, what are the most important points for me to focus on to leave clear instructions to my loved ones to avoid any confusion or drama? So the guy, the financial advisor, replies. He says, a letter of wishes can be added under separate cover to a final will and testament or trust deed. Drafting a letter of wishes conveys the principal wishes of the author to future estate or trust custodians. So let's have a look at that. So what this means is you've got your will, which is basic, standard, and you put in your basic wishes, and then you can add a letter of wishes added onto the will that's part of that will. In there, you can go into a lot more detail on exactly what your principal wishes are and what you would like to happen after you pass away. This conveyance of personal wishes, while not legally binding, so please understand this, this is suggestions of your wishes. It is not a legally binding document, can provide guidance to custodians in their decision making regarding the preservation of family benefits, relationships, family beliefs or values, religion and sentiment. It is against this distinct framework that key management and money decisions should be considered. So this will give guidelines for what you want to happen when it comes to the family, the relationships, family beliefs and values, religion and sentiment. So guys, again, please, the fact is that although it is a clear understanding and a clear outlay of your personal wishes, it is not legally binding. And you cannot go into too much specificity in your will. You cannot rule from the grave. That is a rule or a law that you can't rule other people's lives and take away their freedom after you pass away through what you put in your will. So you can't, for example, say, well, my daughter inherits from me, but if she decides to marry this person, that inheritance will be stripped. It is not how it works through a will. Typical information included in a letter of wishes added as a separate document to a will. So these are the kind of things that you could put into this letter of wishes. The funeral arrangements, the guests to invite, do you want to be buried, cremated, organ donation. Now, saying that guests to invite for me is kind of a weird one. If you want to say, listen, I don't want that person at my funeral, but it's personal choice. Burial, cremation, organ donation, a lot of that is already handled in the will, but you can have that as a separate letter as well. It could make, especially when it comes to organ donation, it could expedite that process. So also the type of service, location, or the scattering of ashes, etc. So you can put it out. Now, currently at I Retire, we are working on a service called If Tomorrow Never Comes, and that service will then help you set up this funeral arrangements so that if in the event that you pass away, your family can focus on the grieving process and not doing administration and planning and trying to make these kinds of decisions. It also talks about distribution of personal items of only sentimental value. So this is things that have sentimental value, not something that is worth a lot of money. So if you have a diamond ring worth 1.2 million rand, then you can't do it and put it in your letter of wishes. That has to be stipulated in your will because it has a high value. So this is more for small things that's got sentimental value, like the older generation. They had these little spoons of everywhere they went and everywhere they visited. You might want those spoons to go to your aunt or your niece or something like that. That's the kind of thing you can put into that letter of wishes. Perfumes, clothing, photos, music, books, self-made items, tools, sports gear, all of those kind of things you can then distribute through your letter of wishes. Guidance for guardians of children in religion, relationships, education, money matters, etc. So it's just a guide for the people who would be looking after your children in the event that that might happen, to guide them in how you would have liked to raise your children. Again, it is not legally binding, but it is a guide for them. Typical information included in a letter of wishes added to a testamentary or inter vivos trust. So this is when a trust has to be set up for the children, a testamentary trust or an inter vivos trust. So let's just quickly talk about what is a testamentary trust and what is an inter vivos trust. So if you, and this is something I see so often with people, they want to already open a trust for their children even before they've passed away without any good reason. So an inter vivos trust is a trust that gets set up while you are still alive. You might be a trustee, you might be a beneficiary, but most often you are not, because you set up the trust like a family trust where the beneficiaries is your children. Inter vivos trust is a living trust while you are still alive. A testamentary trust only gets set up on the event that you pass away. So in your will, it then states that that trust has to be set up for the children, and that trust is built to be a temporary trust. It will go to a certain age, and then the trust will be wound up. Because it's a testamentary trust, the costing is more beneficial, and secondly, the tax is more beneficial than having an inter vivos trust. So if there's no other reason to open a trust and all you want to do is create a trust for your children in the case that you pass away, do not do an inter vivos trust. Rather do the testamentary trust through your will, and if you do it that way, you can then add these kind of letters of wishes to that trust. The first one, the wider description of the objective of the trust than what is provided in the trust deed, so you can expand on what you want the trust to do. Secondly, specific privileges, benefits to certain individuals, such as special care needs. So you might have a child with that has a need for special care, some disability, etc., etc. So you can then specify the privileges of benefits that that beneficiary might need. And the exclusion of certain benefits, privileges, or individuals. So if you want the trust to not pay for your son's car, then you can put that into that letter of wishes. Finally, a letter of instruction can also be included in a will to assist the surviving spouse and children in the aftermath of your passing. So this is not a letter of wishes, this is a letter of instruction. This letter contains a list of instructions on what needs to happen with the necessary confidential information. For example, people to notify the financial advisor, the security codes, keys, bank investment accounts, property deeds, we call it a life file. At Retire Happy, with iRetire, if you become one of our coaching clients, you will receive a life file with all this information that you can put in. So if something happens to you, your surviving beneficiaries or spouse, your children, they take that life file, and inside that life file is everything that needs to be done. So your life file is actually not a letter of instruction, but a file of instruction that explains every single thing relating to your finances. And it is so crucially important to have a place. We don't think of things like my Facebook login, things like my bank card PIN or my online banking login. Those kind of things need to be accessible to our beneficiaries in the event that we pass away. Okay, a letter of wishes or instruction always remains confidential, only seen by executors or trustees. The private nature of this document will therefore not be compromised, even in a legal dispute or grant of legal representation. So there's a couple of things here that I just want to add. All of this are good advice, or is good advice, if you have specific wishes and specific instructions for your beneficiaries, your guardians, your executor, etc., etc. But I always suggest to people, keep your will as simple as possible. Guys, the more things you add, the more variations, the more small things you want to move from one person to the other person, etc., etc., the more complicated the will becomes, the bigger the chance of disputes, the bigger the chance of arguments, the bigger the chance of your whole estate being delayed and not being able to be wound up. So keep it as simple as possible. Yes, I do understand there are certain things with sentimental value that you want to give to specific people. That is fine, you can do that. But don't overcomplicate your will. It should be a very simple document. Okay, so keep it simple. It's that KISS principle. Keep it short and simple. Or in the other way, keep it simple, stupid. So yeah, KISS, keep it simple. It is so important to keep these things as simple as possible, so that when you do pass away, this estate of yours can be wound up as quickly as possible. Your assets can get to the intended beneficiaries. You do not want complications. Okay, so the next question we're going to discuss is employee benefits for small firms. So that is the question. We're going to go for a short music break again. For those of you who are listening on Berg Studio, what we're going to listen to is Thunderstruck. I know you were thinking, when am I going to play this? Because probably the most well-known AC/DC song in history. So let's listen to Thunderstruck. Those of you who are watching on our social media, we're going to continue how an RA works, and then we're going to go over from there into a will, and why it's important to have a will, so you can have a look at that as well. So here is AC/DC's Thunderstruck. Goes wrong, the money in your retirement annuity is still protected for you. On that point, let's just look at the different personalities that you have on a will. Because people get confused. They get confused between an executor and the trustee on the will and the guardian on the will that is specified on the will. Especially executors and trustees. People get confused. So they say, no, but I don't want a company to be the executor because I'm not sure that they will be able to look after my children. Well, the executor doesn't look after the children. The executor's job is to make sure that the estate is wound up. The executor's job is to handle the assets, pay the liabilities, make sure that everything is done, and then pay out the balance of the estate to the beneficiaries. Then the executor's job is done. The trustee's job is to then through the executor's job is also to set up a trust if there is provision in the will for a testamentary trust. The executor then sets up the trust and appoints trustees to manage the trust on behalf of the minor beneficiaries. So the trustee will look after the financial well-being of the children moving forward, not the executor. The executor's job is just to get the estate wound up. So it's very important that the executor is a company or somebody that actually runs with these things every day or every month. The trustee is somebody, I usually suggest that when you look at a trustee for the trust, then you set up a private individual, somebody that you know would have the children's best interest at heart, and you put a financial institution or a financial person, financial advisor or accountant, auditor, somebody like that, or a company that manages these as the trustees of that trust. And the reason I say both is, if you look at those two personalities, the individual person knows your children and they will look at it from the point of view of what is in the best interest of the child. The company, the financial services company, will look at it from a purely financial perspective. They won't look at it from an emotional perspective. So they will look at, does this decision make financial sense to do? And between the two, I feel you'll get a much more balanced decision making for your children going forward. Because somebody who's emotionally involved may only look at it from the point of view of the children and overspend or make financial decisions that's not always positive for the trust. Where the financial institution might look at it purely from a financial point of view, but not take into account what the actual children's needs are. So between the two, there's a I think a more balanced approach. Then we get the guardian. I see this quite often as well, where people make the guardian of the children also the sole trustee of the trust. Guys, that is very dangerous, because what you are basically doing in that scenario is you are giving your children to a person, and yes, I know you wouldn't have given your children to a person as guardian that you don't trust. But we never know how people react and respond when they suddenly have access to millions of rand. You never know how people respond. People justify them. Some of the greatest people in the world have gotten into trouble before because they keep justifying what they're doing. And before they know it, they've mismanaged all the funds because they didn't have the knowledge, or they just got overwhelmed with all the money. So then they make the guardian and the trustee the same person, which then means that not only does that person have responsibility to the children, but they also have access to all the funds without any checks and balances. So it is important that you don't make the guardian the sole trustee. You can make a guardian a co-trustee, but I won't make them the sole trustee. I'll always have a financial institution as part of that as well. On that point,
Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.
and welcome back, everyone. It is good to be back. That was Thunderstruck. Warren says, yeah, this is a song. Yes, Warren, one of their most well-known songs. I really, really enjoy Thunderstruck. Awesome song. It just gets you into the energy of the day and get you going if you listen to it in the morning. Okay, so we are talking about some of the questions consumer ask, what they get answered, what is the solutions, and then I just share with you my thoughts on it, expand a little bit on it, and like I said, if you have any questions, you are welcome to ask me online on one of our platforms, whether it is Facebook, whether it's YouTube, LinkedIn. You are welcome to engage and ask me any of your questions. Also, you can WhatsApp me directly at 082-801-6693. So 082-801-6693. You're welcome to WhatsApp me there. So let's continue with our next question. And the question is as follows. I run a small interior construction business that employs around 40 people. We try to give them the best employee benefits to set them up for secure financial circumstances. However, I find that most employees don't understand or utilize these benefits correctly. How should I manage this going forward? Okay, so this is something I see quite often where people have a group scheme at work, but they have, or group benefits, and they have no idea how this actually works. So what you need to understand is that your group scheme consists of two basic areas or two pillars on which it is built. The first side is the investment pillar. So that's the part of your group scheme that goes and invests in the market for your retirement. So that can be done either through a provident fund or a pension fund, and that is your group scheme or group investment. Then you have your group risk benefits. Now, on your group risk benefits, you've got life cover, disability cover, etc. that the company offers you. So you need to understand that there's a risk portion and an investment portion. It's not just money going into investment for you. So you need to understand what those risk benefits are. The life cover is usually a multiple of your salary. The disability can either be a multiple of your salary or an income protection benefit. There might be some funeral cover, there might be severe illness cover. So sit with a financial advisor, contact our office, chat to our guys, our risk specialists, our investment specialists. They will be able to explain to you exactly what your group scheme actually does. Okay, so let's look at this question. It can be very daunting, or the answer can be very daunting for your employees to understand how their benefits work and how to structure them to best suit their individual needs. The most crucial part is for them to understand the group life benefits, the family benefits in other words. If the employee suddenly passes away, what benefits does the family receive? So that is the risk side. So it's not just life cover, it could be disability cover, it could be severe illness cover. It is important for them to understand that. And which unit trust funds to select when investing into pension or a provident fund. It is also vital for them to understand their options in case of retrenchment, resignation, or retirement. Guys, so there's two things on this. It is important that if you have a group scheme, you sit with somebody that can explain the group scheme to you so that you understand exactly what is being offered, what is it costing you, and what you get for what you're paying for, because at the end of the day, it is still your money going into the scheme. It's still you paying for it, even though you feel the company's paying for it. Secondly, you need to sit with a risk specialist and investment specialist to take this benefits or the investment from your group scheme and fit it into your personal financial plan, so that the two, your personal financial planning, your personal life cover, disability, dread disease cover, your personal investments like your retirement annuities, etc., actually works together with your group scheme and don't work against each other. I see it so often that the financial advisors, all they want to do is they want to come and sell a policy as quickly as possible. So they look at what your needs are, but they do not take into account your group scheme. And then what they've put in place actually doesn't complement the group scheme. It fights against the group scheme. So you're spending money twice on the same thing, for example, or you're paying for benefits that you might never be able to claim for. So it's important to sit with a risk specialist, sit with an investment specialist, and make sure that your personal plan complements your group plan so that these two work hand in glove. Okay, as an employer, it is your responsibility to consistently educate your employees from a financial as well as a psychological perspective to make sure they stay on track with their financial goals. They will in turn pass the lessons on to their families and friends, making an even bigger impact than just the employee. What that sentence or that paragraph focuses on for me is the fact that something that I've been saying for the last 20 years is the financial services industry doesn't need more innovative products. It needs more innovative advice and education. We need people to be educated about these things, and that is our purpose. That is why I do these shows. That is why I talk to as many people as I can, do talks at companies, so that we can educate people around this. I always say money is a game, and you can't win the game if you don't know the rules. So these financial education. So if you are in a company and there is group scheme in the company, there is group benefits, but you don't understand it, talk to your company. Tell them to get in contact with us. Let us come out. I will come and talk and explain to all the employees, educate them so that they understand how these things work for them. Okay, financial advisors also play a vital role in assisting the process involving employees and their benefits. So you can encourage your employees to get in touch with a financial advisor to help structure their benefits in a way that is advantageous to them and their families. So guys, if you are a small business owner like this consumer that asked the question, and you are looking for a group scheme, talk to a financial advisor. One scheme doesn't fit all. So you have to look at what your needs are in your company. You can even structure it with different benefits for different people in your company so that it's built in such a way to optimize the benefits for your employees. But it all starts with financial education. It starts from understanding what it is before you can understand what it actually does. Whenever somebody comes to me and says, I've got this financial product or that financial product, is it a good product? My first question to them always is, why do you have it? What is the goal? Because any financial product, any policy, any medical aid, any investment is only as good as the goal it is working to achieve. So if you have something and you have no goal, then it's not a good product. You're spending money on something that you don't understand the benefit of. So make sure that you get that goal sorted out. Okay, I'm going to quickly run through the last question. We are running out of time. So let's just see what they say. Should I be teaching my children about insurance? So that for me is almost a no-brainer. I don't even know why somebody would ask there. Of course, you have to teach your children about insurance. They need to understand it is one of the biggest single expenses, insurance in general. And yeah, I'm not talking about just short-term or just life cover or just medical aid. I'm talking about any kind of insurance. It's one of the single biggest expenses you have on a monthly basis, is to minimize your risk. Okay, so the youth of today live in a very different world with its own unique risks, which require a different approach to insurance. The emergence of wearable technology and the rapid acceleration of digitalization has heralded an entirely new array of insurable risks. And given the dynamic nature of the risk landscape, parents should view educating their young children about short-term insurance as an important life skill. Now, the answer here is all about short-term insurance. Now, insurance is much, much wider than that. I believe that more important than short-term insurance is your life insurance, your disability, your dread disease, those kind of things. But you have to teach your children what is risk, what are the things that could go wrong, and why do you have to plan for it, and what your approach to risk should be. One of the big things we teach people is that you shouldn't approach risk planning from the point of view of trying to beat what you've got. You need to approach it from the point of view of what is it that you need to look after. So not what do you have, but what do you need. That is the approach. Insurance can provide an important safety net and is an integral part of our financial plan, helping us recover from financial setbacks due to the loss or damage to possessions. A good place to start is to help your children understand their risk profile. This is unique to each individual and based on factors such as age, claims, behavior, where they live, and how they store their valuables. So it's important to chat to your kids about what the different kinds of risks are. Going into their risk profile, I mean, what are you going to do? You're going to tell them they, somebody at school, a student, what is their risk profile? So that might be a little bit too much detail. I'm thinking more, teach them about the overview of what risk is, how you can minimize your risk, because in everything in life there is risk involved. How do you minimize this, or the way that you minimize this influences your chances of being successful. All these are taken into account to determine their level of risk and ultimately their insurance premium. But importantly, some factors are under their control, and parents should always encourage children to put the appropriate safety measures in place and take the necessary precautions to keep possessions safe. That's just normal common sense, but it's things that you need to teach your children. You really need to have an education system around money and around finance. Again, if you are part of our I Retire coaching, your coach will teach you and educate you. You will learn cash flow management systems. You will learn how to budget. You will learn how to pay off your bond. And through that, you have the skills to teach your children. That's why we call it building generational wealth. It's not just the assets that you leave to your children, but it is the education, the strategies, the knowledge, the wisdom that you leave your children that creates generational wealth. You could have all the money in the world, but if you don't teach your children how to manage and win at the game of money, they're going to lose everything. So it's important to educate your children on money as much as possible. Okay, guys, that is our show for today. Thank you for joining me. I really enjoyed running through, even with a little bit of gremlins this morning. I really enjoyed sharing this with you. And we will be back same time, same place next week, 10 o'clock in the morning, every Thursday. Enjoy the rest of the week and then the weekend. No rugby on this weekend. So have a nice, relaxing weekend. And I will see all of you again. For those of you who are listening on Berg Studio, we are going to play out with our last song for the day, and that is Highway to Hell from AC/DC. Enjoy. Cheers, everyone.
Financially raw, real, authentic wisdom with Lourens from Retire Rich and Happy.